Have you ever told yourself, I'll invest when the market crashes?
Oh, I hear that all the time.
Right. Be honest. You're sitting there scrolling through financial news, watching lines on a chart just aggressively bounce up and down, and you think, you know what, I'm just going to wait.
Yeah, wait for the absolute bottom.
Exactly. You tell yourself when everything hits absolute rock bottom, like that is when I'll make my move.
Which sounds incredibly smart.
It does. It feels responsible, prudent. I mean, it feels logical. But here is the shocking truth we're unpacking today. That exact mindset quietly destroys more wealth than almost any market correction ever could.
It really is one of the most profound paradoxes in personal finance. I mean, the very strategy that feels like a rational protective shield against losing your money
Right.
is usually the exact mechanism that guarantees you fall behind over the long run.
Welcome to today's deep dive. Today, we're pulling apart a really fascinating piece of financial psychology from the Master Your Mind Before Your Money series.
It's based on a brilliant Turkish paper, translated as Time, Not Timing, The Power of Consistent Investing.
And the mission for this deep dive is to answer one massive dilemma for you. Should you invest consistently through all the ups and downs? Or, should you hold your cash and wait for that perfect crash?
And just to set the parameters for our conversation right up front, we are dissecting the behavioral psychology of investing today.
Good point. Yeah.
We're exploring how human brains react to money and fear. So this is strictly an educational deep dive. We are definitely not telling you to go liquidate or restructure your retirement portfolio tomorrow morning.
Right. Please don't make major life decisions based solely on our enthusiasm here, not financial advice.
Definitely not.
But to really understand how to build wealth, we first have to figure out why our brains naturally gravitate toward, well, the exact wrong strategy.
The source material focuses heavily on this widespread concept of buying the dip.
And honestly, I completely get the appeal. Like, the logic seems bulletproof at first glance.
It does make sense intuitively.
Yeah, why on earth would you buy an asset today when you have a sneaking suspicion that the whole market might be, 20% cheaper tomorrow?
Right.
It just feels like waiting for a winter coat to go on clearance.
How do you mean?
Well, say you see this amazing heavy winter coat in October and it's full price. You think, I know for a fact this will eventually go on sale in January.
So you hold off?
Exactly. You wait. You basically freeze for 3 months, hoping for a 50% discount rather than just buying it at 20% off in November.
What's fascinating here is that the coat analogy captures the emotional side perfectly, the thrill of bargain hunting. But we actually need to look at the fatal flaw in the mechanics of that metaphor.
Okay, what's the flaw?
Well, a winter coat is a depreciating consumer good. It just sits in your closet and gets older. A stock or a share in a business is a compounding asset.
Oh, why?
So while you're sitting around in the cold waiting for the stock market to drop, you aren't just uncomfortable, you are actively missing out on dividends, company growth, and compound interest. That makes so much sense.
Yeah, the coat in the financial scenario is actually growing in size and value while you wait.
That completely flips their perspective.
Yeah.
Like, I'm sitting there feeling so smart for waiting, but the asset is literally pulling away from me.
Exactly. And beyond the missed growth, the text poses some incredibly sharp mathematical questions that really dismantle the whole buying the dip strategy.
Like what?
Well, if you're waiting for a dip, how far does the market actually have to fall before you pull the trigger? Are you waiting for a 5% drop, 10%,
Right, you'd have to pick a number.
20%? You have to pick that target number in advance.
Which essentially means I have to predict the future. Like, I have to arbitrarily decide that the global economy is going to contract by exactly 10%.
Yeah, and let's map out what happens when you try that. What if the market drops 9.9% and your mental trigger was 10?
Oh, you just sit in cash.
Right, you sit there. Then the market shoots back up to all-time highs. You just miss the entire opportunity because of a fraction of a percent. That would be so frustrating.
Or worse, what if the market goes on a massive multi-year bull run and just simply never reaches your original target price again? You're left standing on the platform watching the train leave the station forever.
Okay, but let me push back here for a second.
Hmm.
Let's say I am right.
Okay.
Let's say my timing is just impeccable. I predict a 20% crash, I wait patiently, and boom, the market plummets exactly 20%, just like I hoped. My target is hit.
The perfect scenario.
Yeah, I should be popping champagne at that point, right?
See, the text highlights this as the ultimate trap. This is where behavioral economics entirely overrides mathematical logic.
Oh, so?
Because when that 20% drop actually happens in the real world, The environment doesn't look anything like the way you thought it would when you made your calm, rational plan.
Oh, because everyone is panicking.
Exactly. When the market is down 20%, the news cycle is basically apocalyptic. Headlines are screaming about a looming global recession, unemployment is spiking. I mean, your friends might literally be losing their jobs.
Oh, wow. So I'm sitting there with my cash. The coat is finally on clearance, but the store is literally on fire, and I'm terrified to walk inside.
That is the perfect way to describe the paradox of fear. We suffer from something behavioral psychologists call loss aversion.
Loss aversion.
Yeah.
Okay, what is that exactly?
Evolutionarily, human beings are wired so that the psychological pain of losing a resource feels roughly twice as intense as the joy of gaining that same resource.
Twice as intense.
Yeah, it kept our ancestors alive, being super cautious. But in modern investing, it just paralyzes us.
Because the stakes feel so high.
Exactly. Your logical brain previously said, hey, buy at a 20% discount. But in the moment of the crash, your survival brain is screaming, danger, hoard your resources, stay away.
So you just freeze.
The result is almost always complete paralysis. You think, well, it dropped 20, maybe it'll drop 30, I should keep waiting.
Man, if our brains are that hardwired to panic during a crash, how do we override that? Like, is there a way to bypass our own broken psychology?
There has to be.
Right. We clearly need a completely different approach that just takes human emotion out of the driver's seat entirely.
And the source material advocates for a remarkably simple mechanism to do exactly that. Dollar cost averaging, or DCA.
Okay, let's unpack this. Let's really break down the mechanics of dollar cost averaging.
Yeah.
Because I think a lot of people assume it's some, like, complex Wall Street algorithm.
Not at all.
It's actually brilliantly mundane. Instead of trying to predict what the market is going to do next Tuesday or next month, you invest the exact same dollar amount on a rigid recurring schedule.
Consistency is key.
Right. So let's say you commit to putting in $500 on the first of every single month. You do this completely blind to the news. You do it if the market is hitting record highs, and you do it if the economy is crashing.
And what's fascinating is that the mathematics of dollar cost averaging are just incredibly elegant.
Because it adjusts itself.
Yes, the system automatically adjusts to market conditions without requiring you to make a conscious choice. Let's run a quick numerical example to visualize this.
Okay, lay it on me.
Imagine you are buying shares in a fund. In month one, the market is booming, and a share costs $50. Your $500 investment buys you 10 shares. You naturally bought less when things were expensive.
Okay, I follow that. $50 a share, 10 shares. Got it.
Now, in month two, the market crashes terribly. People are absolutely panicking. The price of that same share drops by half, down to $25.
Ouch.
Right, but because your $500 contribution is automated, you don't hesitate. You don't have to think about it. That same $500 now buys you 20 shares.
Oh, I see. So across those 2 months, I spent $1,000 total. I got 10 expensive shares and 20 cheap shares, giving me 30 shares altogether.
Exactly.
Which means my average cost per share is now roughly, what, $33?
And that is the magic number. Your average cost drops significantly below the initial high price, entirely automatically.
So you effectively tricked yourself into buying the dip.
Precisely. Without ever having to make the terrifying emotional decision to buy the dip while the store is on fire.
That's incredible. The true beauty of this isn't even about perfectly predicting the market or, squeezing out the absolute lowest mathematical price.
No, not at all.
The true power is emotional regulation.
Spot on. If we look at the broader behavioral insights in the text, there's a fundamental truth we simply have to accept as investors. Markets are deeply unpredictable.
Right. Geopolitics, supply chain.
Interest rates, yeah. No one truly knows what they will do tomorrow, but human emotions like fear, greed, and panic.
We know exactly what those will do.
Exactly. Those are 100% predictable. We know precisely how the human brain will react to financial uncertainty. So dollar cost averaging is really a structural system designed specifically to neutralize our predictable flaws.
It's kind of like building a sturdy fence alongside a cliff.
Yeah.
You know that if panic sets in, your instinct might be to run toward the edge. So you build the fence of automation to keep yourself walking straight forward.
That's a great visual.
And to really cement how this plays out over a lifetime, the source text walks through a very grounded case study featuring 2 hypothetical investors, Sarah and David.
Yeah. Sarah represents our automated dollar cost averaging champion.
The machine.
Right. She commits to her $500 monthly investment without fail. David, on the other hand, represents the strategic buy-the-dip investor. He holds his capital in a cash savings account, just hovering on the sidelines, waiting for his perfect opportunity.
So time passes, and eventually the inevitable happens. The market drops significantly.
Down it goes.
Now, I want to pause here and really explore David's perspective for a minute. Because when that initial drop happens, David actually looks like the smartest person in the room.
Oh, completely.
He is sitting on a pile of cash that has zero volatility, while Sarah's portfolio just took a massive hit. The text notes that David smiles at this moment and thinks, this is it.
His moment has arrived.
Yeah, exactly. But let me challenge the premise for a second.
Mm.
What if David actually times the bottom perfectly? Hasn't he mathematically beaten Sarah? Like, why shouldn't we try to be David?
Well, if David miraculously pinpointed the exact day the market bottomed out and deployed all his cash, yes, his returns in that specific cycle would beat Sarah's.
Okay.
The issue is the statistical improbability of doing that consistently. Timing the market doesn't just require you to be right once, it requires you to be right twice.
So because of selling.
Yes, you have to know exactly when to sell or stop investing to build your cash pile, and then you have to know exactly when to jump back in. The data shows that even seasoned professionals fail to do this over a 20-year horizon.
Wow. And according to the text, David doesn't buy the exact bottom anyway, right?
No, he doesn't.
His initial validation morphs rapidly into greed.
The psychological spiral the text maps out here is just fascinating. Prices fall, David feels smart, but then he wants an even better deal. He wants to squeeze every last drop of value out of the crash.
So he just keeps waiting.
Right, he waits. The emotional goalpost keeps shifting downward. But then comes the turning point that traps millions of retail investors.
What happened?
The market suddenly recovers much faster than anyone anticipated.
Oh, right. For those listening who might not follow daily financial charts, the text refers to this as a V-shaped recovery.
Very common.
It's exactly what it sounds like visually. A violent, steep drop in prices, followed almost immediately by an equally aggressive, steep bounce back up, forming a literal V on the graph.
And when that violent bounce upward happens, David is hit by a new cognitive bias known as anchoring.
Anchoring.
Yeah. He looks at the current slightly recovered price, and his brain anchors to the absolute lowest price he saw 3 weeks ago.
So even though the asset might still be fundamentally cheap, his ego won't let him buy it.
Exactly. He feels cheated. Buying at the new higher price feels like accepting a loss compared to the absolute bottom he missed.
So he's agonizing over what he, could have had.
Yes. So he stays in cash, just hoping it dips back down to validate his anchor price. Months pass. The market marches upward, and his money is earning absolutely nothing.
Meanwhile, Sarah hasn't looked at the news once.
Not once.
She bought the expensive months, she bought the cheap months, and she just let the sheer gravity of time do the heavy lifting.
And this brings us to a really sobering reality check provided by the text's research. This isn't just some fable about the tortoise and the hare. It's backed by hard market data.
The numbers back it up.
Big time. Research repeatedly shows that missing only a handful of the stock market's absolute best trading days over a 20-year period can literally cut your long-term returns in half.
Wait, really? Just a handful of days over 20 years?
Yes, because the stock market does not grow in a smooth, predictable, straight line. The vast majority of compounding gains come down to a very small number of incredibly explosive trading days.
And when do those happen?
Here is the kicker. Those massive upward days almost always cluster around severe downturns. They happen right in the middle of a crash or immediately after, when market volatility is at its absolute peak.
Which is precisely when David is sitting in his cash account, paralyzed by anchoring and fear.
Exactly. By trying to avoid the worst days, David mathematically guarantees that he will miss the best days.
That is wild.
And missing those explosive recovery days kneecaps your compounding interest permanently. This leads the text to its most powerful conclusion. A market crash is not the biggest threat to your wealth.
What is?
The biggest threat to your wealth is staying out of the market for too long.
Wow. Okay, so if the danger of sitting in cash is that extreme, it begs the question, is there any room for nuance? Is the concept of buying the dip just entirely foolish for everyone across the board?
Not necessarily.
The source material actually brings in a heavy-hitting perspective here, citing advice from Warren Buffett, arguably the most famous investor alive.
Yeah, Buffett's philosophy adds a really vital layer of context here. The text notes that Buffett repeatedly advises the average person to ignore market timing entirely and just consistently invest in low-cost index funds.
But let's quickly define that for clarity.
Yeah.
An index fund is a type of investment that simply buys a tiny slice of all the major companies in the stock market at once, rather than trying to, pick one winning stock.
Right, it's a basket.
Yeah. If you're dollar cost average into a single company and that company goes bankrupt, you lose everything.
Yeah.
But if you dollar cost average into a broad index fund, you're essentially betting on the long-term growth of the overall human economy.
And that diversification is what makes the automated strategy safe. But does Buffett's advice mean that holding cash to buy a dip is universally wrong under all circumstances?
I would guess no.
Right. The text says no, but with a massive caveat regarding how professionals actually execute it.
Here's where it gets really interesting. The pros don't view this as an either-or scenario. They don't choose between dollar cost averaging or buying the dip. They actually run a hybrid model.
Exactly. Experienced investors maintain their baseline. They continue deploying their automated investments every single month, just like Sarah.
So they don't stop.
Never. That compound interest machine never gets turned off. But alongside that consistency, they might hold a separate, smaller cash reserve specifically designated for extreme market dislocations.
That distinction is the pivot point of the entire strategy. I really want to highlight this. The professionals do not interrupt their regular investing to build up cash.
Right. They don't pause the machine.
They keep feeding it every month, and they simply add extra fuel when sudden massive opportunities appear. It's the difference between pausing your entire journey to wait for a strong tailwind versus continually walking forward every day and just choosing to sprint when the wind happens to hit your back.
But that's a brilliant way to put it. One method is opportunistic and additive, while the other is paralyzed and subtractive.
Attractive, right?
The text makes it incredibly clear. Adding extra capital during a crash while strictly maintaining your automated baseline is fundamentally different from sitting 100% in cash, doing nothing, praying for a crash to validate your patience.
It all circles back to how we manage our own psychology. Disconnecting your primary wealth-building engine from your fragile emotional state is the secret to long-term success.
Completely.
Discipline builds wealth. Panic, greed, and anchoring biases destroy it.
So as we look at the entire landscape of this deep dive, from the trap of the depreciating winter coat to the evolutionary pull of loss aversion to the tragic anchoring of David.
Poor David.
Right. But the core lesson from the source material just shines through brightly. The market simply does not reward perfect timing. It rewards patience.
Time in the market almost always beats trying to time the market. True, lasting wealth isn't built by watching a chart and making one single, heroic, perfectly timed investment at the absolute bottom.
No, it's not a movie.
Exactly. It is built by making hundreds of slightly boring, highly automated good decisions over decades.
And the source text leaves us with a really brilliant diagnostic question. It challenges you, the listener, to look at your own financial behaviors and ask yourself honestly, are you investing according to a systematic plan, or are you investing according to your daily emotions?
That hits hard. If you are waiting on the sidelines, you're almost certainly acting on emotion. But as we wrap up this deep dive, I want to leave you with one final lingering thought to mull over on your own.
Go for it.
Throughout this whole discussion, we've focused almost entirely on the hard financial cost of waiting. We've broken down the math of dollar cost averaging, the compounding interest you lose, and the monetary penalty of missing those 10 explosive market days.
Which is substantial.
Massive.
Ugh.
But I want you to consider the invisible mental tax. If human cognitive biases like loss aversion and anchoring are as powerful and predictably disruptive as behavioral psychologists claim, just imagine the sheer amount of brain power, anxiety, and daily stress you expend by trying to time the market.
Oh, the stress of watching those lines go up and down every day.
Exactly. Think about the mental energy it takes to constantly refresh the daily charts, to obsessively second-guess the news cycle, to literally lie awake wondering if tomorrow is the day the crash finally happens.
It's exhausting.
It really is. If you automate your investments, if you build that psychological fence and refuse to play the prediction game, you aren't just protecting your financial future. You are actively reclaiming your present peace of mind.
That's a great point.
So ask yourself, what could you accomplish in your life, your career, or your relationships with all that freed up mental energy if you finally stop telling yourself, I'll invest when it crashes?